So how would you invest in 2024? That's a pretty tough question, right? On the one side, the stock market keeps going up, and I have the feeling that I don't want to miss on that party. On the other side, we're a long time due for a market correction. So today, I will show you how I would invest a lump sum of money and restart a portfolio from nothing in 2024. But first, I want to share with you a story because I faced the exact same dilemma back in 2017. So I had that doubt and I did not know what to do. So what happened there is I made two big decisions on that here. The first one, I decided to quit my job at National Bank and started working full-time on Dividend stocks rock. The second one is I decided to take the pension account and start managing it. It was a big deal for me because that pension account was most of my investment back then. So if I failed, well, then here goes my retirement plan, right? So instead of leaving that money at the bank so they can pay me a small pension down the road, I invest $108,000 in a locked-in retirement account. So I could not add capital, and it was just this $108,000 that had to grow going forward to fund my retirement plan. But I remember the day that $108,000 hit my account in August 29th of 2017. I was not too sure how to go with that money because we were trading at a all-time high and the stock market was actually on a solid run since the financial crisis of 2008. So then I was thinking, well, probably that we're going to get a correction, and should I start investing right away? How should I build my portfolio? So this is what we're going to look at today. So the asset allocation, the stock selection process, and also the timing of investing that money. Ironically, in 2018, the stock market dropped. It ended in negative territories, and my portfolio was up by 4.4% by the end of that year. How did I do that? Well, I'm going to tell you a little bit more about my stock selection process. But first, we have to discuss volatility tolerance. In the industry, we usually talk about risk tolerance, but really there's a big difference between risk and volatility. So a risk is something that you're going to maybe go all in a sector, all in on a stock, go for penny stocks or for leverage. So that is risky. Volatility means that no matter what you do, even if you invest in blue chips and rock solid companies, when the market drops, there's no place to hide and your portfolio is going to go down. The difference is the recovery is going to be a lot faster. In order to help you determine your volatility tolerance, you can look online to find an investor questionnaire. One that I really like is the one from Vanguard. It's quite easy, 11 questions, and it will help you shape your investment asset allocation. Why it's so important? Because it will be linked to most of your return. The idea is if you go all in safe in fixed incomes like bonds or GICs, you're going to have a very stable portfolio, but on the other side, you cannot expect to have double-digit returns. On the other side, if you go all in for equities, well, your expected return is a lot higher, but expect also to ride a roller coaster. On my side, well, since 2003, I've been 100% invested and 100% invested in stocks. I just love investing in those companies, reading financial statements, and I don't mind the volatility. So I'm not telling you to follow my lead. It's really important that you select a strategy that helps you sleep well at night. For me, knowing that I maximize my portfolio for the maximum expected return, that was the key. But then here's come the real question. How do I select those companies, right? So we're going to focus on the equity side on this part because this is what I did in 2017 and this is what I would do exactly today as well. I would completely ignore fixed income, but that's because of the asset allocation I want, not necessarily because of what you want, right? So in 2017, I already had my investment process and all my stock research starts with a robust dividend triangle. So what's the dividend triangle? You're not going to find that online unless you read of my stuff, because this is a methodology I developed helping me narrow down companies that are strong dividend growers and increase the likelihood of those businesses that will continue to thrive in the future. So the triangle is formed by three metrics. The first one, I look at the revenue trend. The whole purpose of investing in a company is to find companies that find ways to increase their sales, right? That's the basic of any business. You want a business with growth vectors, maybe by acquisition, maybe by organic growth, by taking market shares. You want a business that finds ways to increase their sales. So I look at the past 5 and 10 years to look at the trend, see if it's cyclical, see if it's trending up, and then I will go to the second metric, earnings per share. Again, once you have found a business that grows their sales, well, the next step is it profitable? So you want a company in your portfolio that has good margin, some pricing power, maybe a moody business that is very difficult to attack if you're a competitor because they have such great business advantages. So a business that shows strong revenue growth and strong earnings per share growth over past the 5 and 10 years, well, will ultimately lead to the last metric, which is the dividend payment. Please note here that I don't really mind about the dividend yield. I do mind about the dividend growth, because looking at a business that grows their sales, grows their earnings, and grows their dividend every single year, well, I do find a thriving business at this point. So those businesses are telling me, they're sending me a strong signal that they are thriving and they are quite confident in their future. So now, how do I find such a gem? Well, I started the research with the Dividend Stocks Rock Screener. So the DSR Stock Screener cover over 1,200 companies, both on the Canadian and the US side. So the way I did it back then, and the way I would do it again, is I would go on the stock screener and start to add some filter, because of course you don't want to look over 1,200 stocks. That would take a while, right? So let's get started with a pro rating of 3 and a dividend safety score of 3. So already those two ratings are offered at DSR, basically showing you all the companies with a robust balance sheet and a solid business model. Then I would skip the dividend yield, because I don't mind if the stock pays a 1% yield or a 5% yield. What I want is a company with a strong dividend triangle. So at this stage, considering that we have 2020 right now in the past 5 years metric, I would just go for 1% annualized growth rate for the earnings per share and for the revenue. I just want basic growth at this point. I'm going to continue to go a little bit deeper later on, but right now my goal is to narrow down my search, not to skip amazing companies that had a bad year in 2020. However, for the dividend growth, I will be a little bit more selective, and I will request a minimum annualized growth rate of 5%. Why? Because I am selecting dividend growers. So I would ignore payout ratio, cash payout ratio, PE ratio, and other advanced filter. The simple reason is, again, I don't want to miss on great companies just because the PE ratio is a bit high. Maybe it's not that high compared to its history, but it's high compared to the rest of the market. So again, the goal here is to have a great list, but not too narrow. Of course, again, after applying this filter, I get 296 companies. Probably a little bit too much. So what I would do then, and I would start to go back here and look at each sector. The key about sector selection here is to select the cream of each sector. And most importantly, only invest in sectors that you understand and that you're comfortable with. So maybe you have been working at Johnson & Johnson for the past 20 years and you have a very strong background in the healthcare industry. Well, probably you should start looking there because you're more confident, you understand the business, and you know what will impact those businesses as well. On my part, most of my portfolio is invested in technology, in financial and consumer discretionary, and then I have like a spread of like 5 to 10% in any other sectors. I go with my favorite one at first, and then I make like complement selection. I believe there are great opportunities in each sector, so it's really up to you to know if you want to have something a little bit more stable, a little bit more generous in terms of yield, or you want to go for growth, but that belongs to you. Again, the best solution is the one that helps you sleep well at night, not necessarily copy my portfolio or anybody else's portfolio. Of course, the stock selection doesn't stop there. There is a mix between the qualitative analysis and the quantitative analysis. In other words, I make sure that I have a clear understanding of the business model and I have a solid investment thesis, so the reasons why I want a company in my portfolio, and I mix this with a robust dividend triangle. But for my complete buying process, that will be part of another video. At this point, if you are looking for a quick way to have this kind of search, you can download the Rockstar list. So the Rockstar list is a list based on the Dividend Stocks Rock Screener. The only difference is you do not have the ability to add more metrics or to save those views and generate it whenever you want. However, if you go to dividendstocksrock.com/rockstar, you will be able to download the list immediately, and every month I'm going to send you an updated version. Of course, DSR members have the luxury of pulling out that list whenever they want without having to play around with the filters, and they can even add more selection there, more filters to refine their research and find exactly what they need according to their investing strategy. Now, the big question of timing. Back in 2017, here's what I did. I invested it all within 3 months. Actually, 75% of my portfolio was built in 3 weeks. Why? Well, literature will tell you that if you invest right away your lump sum of money, chances are the stock market will be on your side because it's not every single day that there's a market crash. So if you're playing the odds in your favor, you invest right away and you don't have to think about it. But I get it. You're going to probably tell me, Mike, sounds a bit too risky for me. I don't want to invest today and having the beginning of a market crash tomorrow morning. I totally get that. So here's another solution. How about you invest 1/3 of the amount that you have every 3 months? Why that time period? Well, in general, a market crash will go down for about 6 to 9 months before reaching what we call market fatigue. I mean, investors, they just don't want to buy, they just don't want to sell. They're tired. So you have low volume, and now the whole market is just waiting for more economic data or other company earnings to determine if they want to buy or sell. But in the meantime, they just stay steady. So if you are about to invest right away, well, then you put some money in. If there's a crash, well, the next 3 months, you're going to be averaging down. And if it's a big crash, well, you're going to continue to more averaging down throughout the next 6 months. So you're not going to capture the bottom, but you will minimize your losses. And at the same time, you will get a pretty good average price for your investment. On the other side, if the market keeps going up, well, you will at least participate in that bull market again, instead of waiting on the sideline and waiting from the big sign that it's time to invest. Hint, it never happens. You're going to wait for 1, 2, 3 years, and in the end, you're just going to miss out on a great opportunity. Again, the point here is not necessarily to exactly invest 1/3 of your money every 3 months. The point here is to have a clear plan. This is what I did in 2017, and I would do it again today. So I determined that my asset allocation was 100% equities. I wanted to have 50% of my portfolio in the US market, the other 50% in Canadian stocks. Then I went for companies with a robust dividend triangle. I selected from my favorite sectors, and then I complement with other companies to build the entire portfolio. The timing I decided was to just go all in, but if I was a little bit more scared about the market, I would just go 1/3, 1/3, 1/3 to make sure that I participate in the market and I'm not waiting forever. So that's the key to invest with conviction. Fast forward today, 7 years after I put my first dollar in a stock in that locked-in retirement account, my portfolio went from $108,000 to almost $275 and counting. Today, I have a very solid portfolio. I'm super happy about it. And best of all, it keeps increasing its dividend every single year. So now, if you have enjoyed this video, give me a thumbs up, subscribe to the channel not to miss the next one next Thursday. And in the meantime, don't forget to stay invested.